have ended up, we had 300 shares left of treasury stock. And then all of my opening balances plus the first 4 entries. Now we're ready to move on to September 15th. And we're reselling another 100 shares. But this time, we are selling it for what would be usually considered a loss. Remember back up in July, we bought them for $53 a piece. Now I'm selling them at $48 a piece. That's not usually too good. So, what are we going to do here? Okay, so what's the first thing? What did the company get? Cash, right. We sold stock, so we brought in money. Now, why did I get cash? What's going to be my credit? What did the company get? How did they get cash? What did we do? Sold treasury. And how much is that treasury stock valued at that I sold? Notice I skipped a couple lines.
It was $53, wasn't it?
Right. So what do I got to do my credit as?
So 5,300.
Yep. Now, I got to determine now what are going to be my debits to show this in a way it's kind of like a loss. Well, the first thing we got to do, if we can, is we remove any of the gain that I have. Remember, this was kind of like a gain account. We don't call it a gain because it's in ourself. But the first thing I do is I remove as much gain as possible to get me, hopefully, to cover everything. But that's not going to even cover everything. The rest of it comes out of my retained earnings. And we had an opening retained earnings. I forgot to put that up here. It was $10,000. So that extra $300 that I'm still missing has to come out of my retained earnings. I do not want to have a negative balance. So I can't get this below, can't have more than $200 because I only had $200 there. So that's a gain to start with. Okay, October 1, we are now issuing our other type of stock, our preferred stock. I'm going to have to erase this. I didn't move it far enough over. When I issue the preferred stock, I'm still getting cash. Just instead of giving out common stock, I'm giving out the preferred. It tells me I'm issuing 300 shares, and they're valued at $100 par. Of course, this came from the $110 times the 300 shares. Preferred stock, just like common, is valued at its par cost. And the rest goes into our additional paid cap. Two things going on December 15th. We're issuing a dividend, and I also gotta be able to know what to do with net income. Let's start with the net income piece. How do you get, where does net income come from? What accounts make up net income?
Revenue,
Yeah.
I want to say revenue and expenses.
Yep, revenue less expenses equals my net income. What do I do with revenue and expenses at the end of the year?
Zero amount.
A zero amount, close them out. So if I have a $10,000 net income, which I tell you, let's just pretend what something would be in the revenues. Let's say it's $50,000 and $40,000 in expenses, just to have something to give me the $10,000 net income. This number, since these get closed, what do those get closed to? What's my revenue get closed to? Huh? Trey?
Income summary?
Okay, income summary. So if I had a revenue, I would debit the revenue for $50,000, credit the income summary for $50,000, and then the expenses is just the opposite. Income summary of $40,000, and I'm going to close my expenses for $40,000. So right now my income summary has a $10,000 credit balance. If I was to show that, income summary, we had 50 and 40, so we're left with 10,000. How do I get rid of that 10,000? I can't keep it. Where does it go to?
Retained earnings.
Retained earnings. So I'm going to debit my income summary, credit retained earnings, and that's why this is important. I need to add $10,000 to my retained earnings. I don't want to just leave that net income and not update this part of the balance sheet. What's the last thing that gets closed? My revenues, my expenses, and my dividends. Well, let's go ahead and do this then. Let's do our dividend journal entry, and then let's close it. We can't close if we don't even have one. So let's determine our dividends. Board decides to issue $5,000 in dividends. Well, if you took out money out of your company in your widget project, you would have had a debit for your drawings, or in this case it's a dividend. So debit your dividend. Credit, you would have typically credited cash, but in this case we haven't paid it yet. So I'm going to say dividends payable for the preferred and dividends payable for the common. And we need to decide who gets what. How much dividends do my preferred stockholders get, and how much dividends do my common stockholders get? Take a minute. think about it. Think about what we did on Tuesday. And then we'll go over it here in about, we'll give you about 1 minute to look at it. Who do we have to figure out first? The preferred stock, right. And how many shares are out there for the preferred stock? Let's start there. How many shares have I issued and are outstanding?
300.
Yeah, 300 shares. We always have to find the preferred stock and see how much we have to give them, because remember, they get first dibs. So we have 300 shares out. But to determine my preferred stock, I go back up and I look at it, and it pays out 5% of the par value. Remember, it's 5% of the par. So they pay out $5 a share in dividends. 5% of $100. And then you just simply multiply that by the 300 shares. So my preferred stockholders get $1,500. My common stockholders would get the rest. Now let's do the last entry, and we're going to come back to this one in just a minute. But let's do the last entry like what we were doing here. We need to close out the dividend. I had 5,000 and I need to get rid of that 5,000 now. And put it over here in retained earnings. So here's all of my closing entries. The last thing I have us do is prepare the stockholders' equity section. We're going to do that next. But first, we're going to look at what I mean by DPS, which stands for dividends per share. What I have here, dividends per share, and earnings per share, EPS, earnings per share. First one, dividends per share. I already know what the common stock or the preferred stockholders get per share. They get $5. It's just set. But did the common stockholders really do better on a per share basis? They got more money, true, in total, but did they do better on an individual basis? That's what we want to figure out. It's easy to do. All you got to do is just take your dividends per share equals your common stock dividends divided by number of common stock shares outstanding. The top part, the numerator here, is very easy. I already tell you that. We already determined that, 3,500. It's the second part that's the harder part. Number of shares, and the key word here is outstanding. How many shares are still out in the public hands? that I have issued and are still out there and I haven't bought them back. But I don't hold. Trent? Remember, you can go back to your T account, that helps. Knowing that these are $1 a piece per share, so that makes it real easy. 1,000 shares, 1,000 shares, 200 shares. I've issued 2,200 shares. But how much are still outstanding? Just because I issued them doesn't mean they're still outstanding. What do I need to take out of the issued to figure out what's still outstanding? Trent?
I was gonna say treasury.
Yeah,
stock.
your treasury shares. And my treasury shares, I didn't update my treasury stock yet. I still have, if you had your little sheet going, you should show that you have 200 shares left. So I have 2,000 shares outstanding. Thus, my dividends per share is $1.75. The other piece that investors want to know, of course they want to know the dividends per share. How much do I plan on getting? So in this case, $1.75 per share, the preferred stockholders on a per share basis got a lot more. Now, not all companies give out dividends, or they don't give out a lot of dividends. And so what an investor will look at then is their earnings per share. What that basically means in common language would be, if best case scenario, if the company gave out all of their net income, so that's what the owners should be getting, is if the company made money, that should be given to the owners. But remember, sometimes they reinvest it in the company instead of giving out to the owners. If, best case scenario, they gave out all the money in net income, how much would we get as common stockholders? So we're going to take, instead of how much dividends did we get actually, best case scenario, giving out all our net income, less what the preferred stock is due. Because remember, preferred stock gets their stuff first. So we have to take that out up front. Divided by the number of common stock shares outstanding. My net income, I told us that back up in the original problem. Preferred stock, we already did that one. We decided they were going to get 1,500. what our T accounts, what we did those for. And what I would do if I were you is to make it as less writing as possible. I don't expect you to necessarily remember the layout. So what I allow you to do on the test is simply take your beginning sheet and draw a line. These are our old numbers, what we started the year with. And then draw a line and put your new ending numbers out here. So instead of preferred stock being 0, draw a little line, it's now at 30,000. The reason why I had you to keep your T accounts is so on the test I'll say go ahead and update and make the new updated stockholders equity, and you'll simply draw a line, and then by keeping your T accounts you'll make the owner's equity part of the balance sheet. The only difference that I have in this example on the answer key that is I added a line here because I think that's how they do it in Wiley Plus. And so for Wiley Plus, I forgot to add it on your sheet, but I put it in here, right above retained earnings and right below the total for additional paid-in capital. I added a line there and totaled up the two yellows. If history serves, on the test, only about 25% of you, so about 3 of you in class, will have completed this page of the test. Most of you will lose all the points on this page because you'll either barely complete it or you won't even complete it at all. We'll see how if that continues. And by the looks of people writing everything down, which they're not, I'm going to guess that's going to be the case this year as well. Okay, I can send this out as answers if you email me, but we need to keep going. And we're going to see how well you really know this stuff, exactly what it will be on the test in 2 weeks. And how much is going to go to common stock, preferred stock, I mean?
15,000.
And how did you get 15,000?
I took, let me see. You have to oh, I can't remember. I took however many stocks that we actually got and then times them by their original value.
The par value.
Yeah.
Yep. 300 shares issued at $50 par. Again, that information is found on the number 50 sheet. And what's your last credit?
Accounts for, I can't remember the names of them.
Additional paid-in capital.
Yeah, for 7,500.
Okay. Very good. Okay, Ariana, second one. What'd the company get?
Cash, 30,000.
Good. How much went to the common stock? 1,000. Okay. And what was your last credit?
The additional paid-in capital, common stock.
Good. Paul, you got the hardest one. And I did that on purpose because I think you can handle it. What'd the company get?
6,000.
Okay. And where'd that 6,000 come from? I'm selling treasury stock, but I haven't bought any backup here yet.
There was a balance of 200 shares.
Yes. If you had a little inventory sheet going, I tell you on number 50, you look down to the treasury stock part, there was 200 shares at, how much was it, $4 a piece, to equal $800 total. So, Paul, then, if I got cash of 6,000, what's my credit here?
Treasury stock for 800.
Good, I have to get rid of all of that treasury stock. I sold all 200 shares. So now I'm down to nothing in treasury stock. And the rest of it, Paul?
Additional paid capital.
Very good.
How did you get the 800?
From the original sheet, number 50, on the original sheet, number 50, at the bottom, towards the bottom, it has treasury stock. And it tells me there's 200 shares at $4 a piece already in the company from last year. And then I sold those 200 shares, so I have to get rid of the treasury stock at what it cost me. All right, the next one is March. And Trent had this one.
Accounting expense.
Yeah, what did we get? We got the services of accounting, right?
Common stock. 500.
As a debit or credit?
Credit.
Credit for $500, yep, 500 shares at $1 par,
And 1550 credit for.
15,500.
Yeah, that's good.
And what did I give this to, Sarah? Yeah.
I debited treasury stock for 28,000
We're good,
and then credited cash for 28,000.
very good. So now I have new stuff in my treasury stock. 700 shares at $40 a piece. And then I think we went to Maria.
Yep.
When we resold some of those stock, we resold 300 of the 700 shares. And what'd you do? What'd we get?
First I debited cash for 13,800,
Okay, good.
and then my credits were to the treasury stock for 12,000,
All right.
and the rest of it went to the APIC treasury stock for 1,800.
Good. And the 12,000, this one should be pretty obvious. We sold it for we sold 300 shares at $46 a piece. The treasury stock, I come over here, I take off 300 shares at 40 bucks each. So I just lost 12,000 in treasury. And put the rest of the gain in my additional paid in capital. Okay, Melissa, yours is similar, except we sold them for a loss. So how much money did we get?
We got 13,800.
We shouldn't have got the same. On the 15th?
Oh, I'm sorry. No, I was looking at the wrong one. 10,500.
Okay. 10,500. And what else did you do?
And then there's a credit for treasury stock to the 12,000.
Okay, good.
And I did an additional paid, or the 1,500 for, is it additional paid in cash, treasury stock,
Additional paid in capital
capital, sorry,
as a debit or credit?
as a debit.
Yes, like a loss. And I can take 1,500 out because I have 1,500 to draw from. If I didn't have anything in there, then I would have had to do something else, but I have 1,500 to take away from my gain. So I have another 300 coming out of treasury stock, another 300 shares at $40 a piece. So I'm left with 100 shares now at $40. So that's $4,000 still in treasury stock. Okay, let's, now the last, December 15th, and I don't remember if when I did the answers, if I did this one the easy, or if I actually did it the harder way with the cumulative. What did you get, Rebecca?
Okay, I got dividends, is 15,000.
Right?
Preferred stock dividend, since it's cumulative and they didn't pay any last year, there's $2,000 out of the 15,000 for this year, plus 500 out of the 15,000 for last year, which is 2,500 for preferred stock
Yes, that's
dividend,
right.
and then your common stock dividend would be 12,500.
Okay, yep. We don't have time to really get into how she got this answer, but I'm not gonna have one quite this difficult on the test. It'll be more of just this year's stuff, just knowing how to do the number of shares times how much the people get. Remember the percent of par times the number of shares that are issued. And that's all I'll have for the test. I won't go into this detail. And then the last one, Brandon, what do we do with that net income?
I debited income summary and then credited retained earnings for 30,000,
Good?
and then debited retained earnings for 15,000 and credited dividend 15,000.
Perfect. He's already assuming that we closed out our revenue and expenses to income summary. We've closed out our net income, revenue and expenses to the income summary. Now we're closing the income summary out to retained earnings. So I would have 30,000 here. And I'm closing out the 15,000 in dividends. And then if you ask me and email me, I will send you as well this, which is the updated answers to how the test will be laid out. So like our preferred stock, which is what my T account shows, 20,000, 2,500 in the common, And then you should be able to get your answer for each one. It's very easy to do. Should not miss out points on this part of the test. But I can send you this, but we don't have time to really write them all down right now.